Welcome to Legal on Demand, powered by Maguire Legal. Conversations on law, business, and the decisions that matter. I'm Sonia.
And I'm Edda. In this episode, we're talking about a major legislative change that every employer should now be preparing for, and that is Payday Super. So keep listening if you want to learn how Payday Super will affect you and your business. The Australian Taxation Office estimated that for 2022 to 2023, there was a net super guarantee gap of around $6.2 billion, meaning this amount was not paid on time. This is a major driving force why the government wanted to introduce these changes.
This reform is no longer just policy. The Treasury Laws Amendment Payday Superannuation Act 2025 has passed Parliament, and the new requirements commence on 1 July 2026.
For executive teams, this is a significant operational and financial shift. Payday Super changes the timing of super contributions, but the real impact is on cash flow, systems, governance, and compliance risk.
Let's start with the core change and what the new law requires. Currently, employers are required to pay superannuation guarantee contributions at least quarterly.
From 1 July 2026, employers will be required to pay super at the same time as salary and wages are paid, effectively each pay cycle.
The government's objective, as outlined by the Treasury and the ATO, is to reduce unpaid super, improve transparency for employees, and allow earlier detection for non-compliance through real-time data.
With single-touch payroll already reporting wage information each pay run, aligning super timings brings super into that same real-time compliance environment.
From a business perspective, this matters for employers as it moves super from a periodic liability to immediate employment cost.
That's right, and that has three major implications: cash flow, systems capability, and risk exposure. So if we step back from the policy intent and look at this from a business perspective, the question most executive teams will be asking is, where will this hit us first?
The most immediate impact is working capital and cash flow impact. Under the quarterly system, businesses could hold super liabilities for up to 3 months. From July 2026, those amounts will need to be funded each pay cycle. For organizations with large workforces, weekly payroll, or tight margins, that's a material shift.
To put that into context, let's take a simple example. Imagine an SME with a weekly payroll of $100,000. Under the current system, the business might hold around $11,500 in super each week and pay it quarterly, which means they could be holding more than $130,000 before the payment is due. CFOs and finance teams should already be modelling the impact, particularly where payroll costs fluctuate or seasonal labour is involved. From 1 July 2026, that same business will need to fund that $11,500 every single week. If cash flow is tight or revenue is uneven, that's a very different working capital position.
And if payment is delayed because the funds are simply not there, that's when Superannuation Guarantee Charge risk starts to arise.
Can you explain what the Superannuation Guarantee Charge is?
The Superannuation Guarantee Charge, or SGC, is what applies when super isn't paid on time or isn't paid in full. It's more than just a missed super amount. It includes a super shortfall calculated on the total salary and wages, interest currently set out at 10% per annum from the start of the quarter, and administration fees for each employee. Importantly, the SGC isn't tax deductible, which means the cost to the business is significantly higher than the original super liability. And it's important for employers to understand that the SGC isn't just the super amount you missed.
So basically, if super isn't paid on time, the SGC applies, which includes interest and administrative penalties, and it's not tax deductible. The SGC is made up of 3 components, though. Can you run us through what they are?
First, the super shortfall, which is calculated on the employee's total salary and wages, not just ordinary time earnings. so the amount you owe can actually be higher than the original super obligation. Second, there's interest, currently calculated at 10% per annum, applied from the start of the relevant quarter, not from when the payment was due. So the longer the delay, the more that liability grows. And third, there's an administration fee, charged per employee per quarter. While the dollar amount per employee might seem small, across a large workforce it adds up quickly. On top of that, employers are required to lodge a Superannuation Guarantee Charge statement with the ATO. If that statement isn't lodged, the ATO can impose additional penalties.
To bring that to life, consider a common scenario we see. A business misses a quarterly super payment for 20 employees with a total liability of around $25,000. Because the SGC is calculated on total salary and wages rather than ordinary time earnings, the shortfall amount increases straight away. Then interest at 10% per annum is applied from the start of the quarter, not the due date, and the administration fee is added for each employee. So by the time the SGC is assessed, the total liability can easily exceed $30,000, and none of that is tax deductible.
If the employer hasn't lodged the SGC statement voluntarily, the ATO can also impose additional penalties and increase its level of monitoring. And this is where the financial impact becomes significant. Unlike ordinary super contributions, the SGC is not tax deductible, so the cost to the business is materially higher. There's also reputational and governance risk. Once the ATO is involved, the organization may be subject to closer monitoring, and in some cases, directors can become personally liable under the director penalty regime.
In the context of Payday Super, where contributions will need to be made each pay cycle, the margin for delay becomes much smaller, and even short-term cash flow pressures or system errors could trigger an SGC exposure, which is why this reform really shifts super from being a periodic compliance task to something that requires strong, real-time controls and oversight. So, Sonia, what is the second major issue with Payday Super?
The second major issue is systems and operational readiness. Payday Super requires payroll processing, clearinghouse transfers, and super fund reporting to operate efficiently every pay cycle, not just once a quarter.
That shift sounds simple, but operationally it's significant. What used to be a periodic batch process now becomes a real-time, recurring transaction environment. Executive teams should be asking some practical questions such as, can our payroll system calculate and transmit super accurately each pay run? Are system upgrades or vendor changes required before July 2026? How long does our clearinghouse take to process contributions end to end? Are there delays between submission and allocation to employee funds? And importantly, do we have reconciliation processes to identify errors quickly? Because under the new model, timing really matters.
If there's a lag between payroll processing, clearinghouse submission, and fund allocation, employers may still be exposed if contributions aren't received within the required timeframe.
Exactly. And for organisations with multiple pay cycles, high workforce turnover, variable hours, or complex award structures, the risk of calculation or transmission errors really does increase.
This is where system capability becomes a governance issue. Payroll automation, integration with finance systems, and data accuracy all become critical controls. The ATO has made it clear that digital reporting and data matching will be central to enforcement. With single-touch payroll already providing wage data in near real time, discrepancies between reported earnings and super contributions will become much easier to detect.
Which means errors or delays won't sit unnoticed for a quarter anymore. They'll be visible much sooner, and that means potentially within weeks.
A practical example might look like a business that processed payroll on time each fortnight and assumed super had been paid correctly. In reality, the clearinghouse submission failed due to a data error in several employee detail funds. Because there was no automated reconciliation or exception alert, the issue wasn't picked up for 2 months. By the time it was identified, multiple pay cycles of contributions hadn't reached the employee's funds, and the business was required to self-report and address superannuation guarantee charge exposure.
Under Payday Super, that kind of gap could occur across multiple pay runs very quickly, and without the real-time monitoring and exception reporting, the financial and compliance risk escalates much faster too.
And when issues are identified early, the window to correct them before regulatory action is much smaller.
And this is why organisations should be thinking about exception reporting. So, for example, alerts where super hasn't been transmitted for a pay run, variances between expected and actual contributions, failed clearinghouse transactions, and even employees without a valid fund or with incomplete data.
There's also a data quality aspect. Payday Super increases the importance of accurate employee fund details, choice information, and onboarding processes. Errors at the front end will flow straight through the system every pay cycle.
From a leadership perspective, this isn't just a payroll configuration exercise. It's about data integrity, process design, and internal controls. And importantly, it's cross-functional. Payroll, finance, HR, IT, they all need to be aligned because if one part of a process fails, the compliance risk sits with the organisation.
The organizations that manage this transition well will treat Payday Super as a systems and control project, not just a legislative update. Okay, Anna, we've covered issues 1 and 2, cash flow impact and systems operational readiness. What's the third issue?
So the third issue is that there's also an important workforce and employment dimension to Payday Super. Superannuation isn't just a tax or payroll obligation like we've discussed. It's a statutory workplace entitlement. And with increased visibility through ATO online services, employees will be able to see whether contributions are being paid accurately and whether they're being paid on time.
That visibility changes the dynamic. Under the quarterly system, delays or errors might not become apparent for months. With more frequent payments and improved reporting, employees will know much sooner if something doesn't look right.
And that means issues that might previously have been picked up internally could now come to the organisation's attention through employee queries or complaints. We're likely to see an increase in questions to payroll and HR, particularly where contributions don't appear in a fund as quickly as employees might expect, or where there are discrepancies between payslips, ATO records, and fund balances.
If those concerns aren't handled promptly and clearly, they can escalate from internal grievances to Fair Work complaints, union involvement, or even direct reports to the ATO.
We've seen this play out in practice. So in one case, an employee noticed through their ATO online account that super contributions hadn't been received for several months, even though their payslips showed super was being deducted. The employee initially raised the issue with payroll, but when the response was delayed, they lodged a complaint with the ATO and also sought advice about a potential underpayment claim. That single inquiry triggered a broader review and it ultimately identified system issues affecting multiple employees, turning what started as an individual query into a wider compliance investigation.
Under a Payday Super environment, those concerns are likely to arise much earlier. And the expectation from employees will be that the organization can explain and resolve these issues quickly. There's also a broader employment law risk. Failure to pay super correctly or in time can form part of underpayment claims, general protections disputes, or broader wage compliance investigations. And in the current environment, super compliance is increasingly viewed alongside wages and entitlements as a part of an organization's overall workplace compliance profile.
Which brings us to the reputational aspect. Employees expect super to be paid correctly, and when it isn't, the issue quickly becomes one of trust, not just administration. For organizations competing for talent, particularly in professional or regulated sectors, repeated payroll or super issues can affect engagement, retention, and employer brand.
This is why Payday Super isn't just a finance or payroll reform. It requires strong communication and expectation management with employees. For example, making sure payslips clearly reflect super amounts, explaining processing timeframes between payroll and fund allocation, and ensuring payroll and HR teams can respond quickly to queries. From an executive perspective, this sits at the intersection of compliance, employee experience, and organization reputation.
The organisations that manage this well will treat Payday Super not just as a regulatory obligation, but as part of their broader people, governance, and trust framework. So, what should boards and executive teams be doing now with the start date of 1 July 2026 approaching very quickly?
Well, there are 4 key areas to focus on. First is financial planning. Model cash flow impact and ensure funding capacity is aligned with pay cycle contributions. The second is system readiness. Engage payroll providers and software vendors to confirm capability and identify any upgrades as required. The third is operational alignment. Payroll, finance, and HR need to have a coordinated approach. This is a cross-functional change. And fourth is compliance control. Review reconciliation, audit, and reporting processes to ensure contributions are accurate and timely.
The risk we often see is organisations treating this as a payroll task. But in reality, like we keep saying, because it is really true, that this is a governance and operational change.
So, Ada, what are some practical preparation steps that a business can take now?
Well, based on current ATO and Treasury guidance, employers should be working through the following. Map your current super payment and processing cycle. Confirm payroll and clearinghouse capability for pay cycle payments. Model financial impacts across different payroll scenarios. Review internal controls and reconciliation processes. And lastly, develop an implementation timeline ahead of July 2026.
Adding to that, it's important that businesses allow time for testing. Waiting until the last quarter before commencement increases the risk of system failures or compliance gaps.
I agree. There's no harm in testing systems early before these changes go live and the financial risk significantly increases.
Wrapping up, Payday Super is part of a broader trend in relation to regulatory direction. We're seeing employment obligations move towards real-time reporting, transparency, and earlier enforcement.
Single touch payroll was really just the first step. Payday Super continues that shift.
The implication for employers is clear. The regulatory environment is becoming more immediate, and the tolerance for delay or error is getting smaller.
The key message for employers is this: Payday Super is more than a timing change. It affects cash flow, systems, governance, and risk.
With the law now passed and commencing on 1 July 2026, the organizations that start preparing now will manage the transition smoothly. Those that leave it late may face operational disruption and compliance exposure.
If you'd like support reviewing your payroll governance or preparing your organisation for Payday Super, you can contact us via our website at maguirelegal.com.au.
And if you have any requests for topics that you'd like us to cover, please let us know via our website or comment section below.
Thanks for joining us on Legal on Demand, practical law, real decisions on demand.